addition to the S&P 500, and the stock has just experienced a nice little run up there. Anyways, it's kind of just a fun little fact, I guess, if you were paying attention. The S&P 500 today showed a pretty impressive comeback here. It did. We did have it. I'm sorry, I'm still distracted over here. I've still got an open position that I need to get rid of. So just give me a moment, and I will get right to that. Anyways, while I'm doing this, this Monday we'll be at the New York Traders Expo. That is myself. I know Joe Donahue, Upside Trader, Anne Marie. I think that Weekly TA is going to be there, and a bunch of other people talking Monday morning. I've got a talk that Monday night as well that will be simulcast. I've posted the link for that if you're interested. So go ahead and take a look at that. Anyways, let's take a... Why the heck is this not going? Okay, day plus. Okay, there, I'm out. So I apologize. So let's get started here. The S&P 500, as we know, gapped down this morning, and it came right to just about that 5-day moving average, the rising 5-day moving average. I was telling subscribers yesterday that it was nice to see that we had gotten up to this level of resistance, but that what we wanted to see today was maybe a pullback down towards 107.5 and then a break past the 108. So basically it was a except from a day trading standpoint, it was a whole bunch of nothing day as we finished basically, well, down 9 cents today, but there was obviously a big range in here. I pointed out on the on Alpha Trends this morning that the range from the February high to the February low, basically if you take a look at the Fibonacci levels starting from the high here to the low, we had retraced almost precisely 61.8%, and that level was further a level of importance because it was this prior support that actually, if you back it up even further, that is, take a look further back to the left and we draw just a horizontal line across that, you can see that it's been an important level back in late November as well as a area of support, and then we tried to stabilize there actually at the end of January as well. So we're at an important level still on the S&P 500, and really look at the daily time frame, we're still below this, well, we're above the 10-day moving average, which is just kind of starting to flatten out, but we're also below a declining 20 and 50-day moving average. So you really can't put much trust into these, you can't put much trust into these rallies here, basically, is the way I see it. You have to look at it and say that, we're in a downtrend here, over the intermediate term time frames, basically since the beginning of the year. And we're going to need to see the market get back up above that 110.60, 110.70 area, which is where we have approximately, if we get up towards that level by that time, the 50-day moving average will decline down towards it as well. So it still remains mixed messages across different time frames here. We're starting to see some stabilization over the intermediate term time frame. If you look at, this is where we finished out last week, so we were up slightly for the week. But more importantly, what happened was we had seen resistance at this declining 5-day moving average a couple times. We held back above it as it flattened out. Today we came down and tested it, and now it seems to be holding as some support. So early next week, early next week would be Tuesday because we're closed on Monday, obviously. We want to see this market get back above, I'm saying about 108.25. If we can get above and hold above for, let's say, a half hour or so, then I think that it will be in a better condition for this market to be able to, to kind of hold on to some gains and then be able to add to it. Otherwise, this is going to be an important level down here at about 106. If we break below 106, I think that means basically that this little, it's still looking like a bearish flag, but breaking 106 could lead to another drive lower, which I think would be, at that point, in a position to set us up for a test of the 200-day moving average. The 200-day moving average kind of coincides with a little bit of prior support in here, and that's at about 103-ish area. Where'd my trend tool go again? This always happens to me. I see why. Okay. But anyways, that's at about 103 or so. And that is the the 200-day moving average. We can take a closer look and see exactly where it is. Let me just open this up a little bit further. The 200-day moving average looks like it is 102.60. So I still think that that's a possibility here over the next couple weeks. Right now, it's just not obvious that it's immediate. But what could set up such a move lower would first be a break of that about 106 area. So you still have to basically tread cautiously in this environment. It's still a dangerous market. A lot of people yesterday were feeling good about this market, and as the market was showing highs for the week, it held on to those gains, and then we had this gap lower, and that's exactly what I was saying last night to subscribers. That in this environment where we have so much news and headline risk that we have to really be aware that we can have these little pullbacks, and that these little pullbacks could occur based on basically based on news events, and we've got a lot of headline risk throughout the world with the sovereign funds. We're still in the middle of earnings season, so that's something to consider as well. But the S&P 500, on the daily time frame, it's still looking ugly. So that's really the big takeaway here, is that on the weekly time or the daily time frame, we're still in a period where you have to use extreme caution. The weekly time frame is telling us a slightly different story, which is we're still in a primary uptrend here. If you look at the direction of the longer term moving averages, the 20, the 30, and the 40-week moving average, they're still heading higher. But that that 40-week moving average again is down near this prior bigger level of support. And of course, the 40-week moving average is approximately equal to the 200-day moving average. So we've seen heavier volume, obviously, the last couple weeks as this market has declined. Now we're seeing some bigger volatility in here this week, and that's generally, just the market trying to find its footing. It's not certain that it's found that footing yet, but if it does and we can get above and hold above 108.26, perhaps we run up to the next level of bigger level where we would expect to encounter some resistance at about 110.60. And right now we've got the 50-day moving average right in about that same area as well. So above 108.26 or 25 and holding that level could set us up for a test of 110.50, breaking back below 106. Then we've got to look at the possibility of that 200-day moving average. So that's the S&P 500. The NASDAQ showing a little bit more firmness here, I guess, during this week. If you take a look at where we had closed last week out, right around in here, we did see bigger gains in here. We are holding this rising 5-day moving average, and the gap lower. When you gap lower and you've got that rising 5-day moving average, then you want to shrink it down to shorter term time frames. And to me, it just wasn't clear that this market was going to recover the way it did. There were some great moves in individual stocks once again today, and that's really been more of my focus than the market. Last week it seemed as though the better focus was on the overall market. I guess I shouldn't say that, because earlier in the week I had some nice trades based around the IYR. But the individual stocks have been where it's at. Now the NASDAQ, the bigger level in here is $44 a share. So we're getting close to that level. So we're at a potential level of resistance that if we break above this 44 level, let me redraw that so I can so it has so it's straight. But we had a declining 5-day moving average where the market was finding resistance and rallies were failing, based on a declining 5-day moving average. We had some higher lows in here this week. So you look at it, it's starting to look a little bit more constructive on the intermediate term time frame. We broke the downtrend line. We broke above the 5-day moving average. We have these higher lows. We have higher highs. And we gapped lower and held above that rising 5-day moving average. So this becomes an important level of support. So in other words, this morning's low is at about 43.15 or so. Next week, I think the bigger level, that if we break 42.65 or so, then we're going to be looking at further decline. This daily time frame still looks terrible as well. These, it's just looking pretty ugly. We're up to a declining 20-day moving average where we have this prior level of support, which is that resistance we were just looking at on the 65-minute time frame. And this level is $44 a share. So if we get up above 44, where does the market have the potential to go before it's likely to encounter a source of supply that's going to offer enough supply that it'll become resistance? Well, looks like most likely I'm near 45, near where these prior highs were, and take that back to last year, this level here. So 45 is a pretty big level. And so that it shows that basically the NASDAQ seems to have limited upside. If it got above that 44 and held there, though, it could probably get up to 45 pretty quickly. And then I think we have to kind of step back and see how the market absorbs any supply that comes into that area. We would expect supply to be there because it's been a prior level of important resistance in the past. And it's where we have that 50-day moving average. That's this green one right here. So, limited upside is what it looks like if we can get above 45. But the encouraging thing, I guess, is that you look at the semiconductors, and the semiconductors have led this market both lower and higher. So yesterday, what I was pointing out to subscribers was that if we cleared this first level, and we were looking for maybe a pullback and then a move up to the next level of potential resistance, and that was right here, and it basically did it, 26 and a half, 26.40 really. The next potential level for this market to encounter resistance up at about 26.80. Let's look at that on the 60-minute time frame, 65-minute rather. So we have this, we have in here, we have these higher highs and higher lows on the NASDAQ, or I'm sorry, this SMH. So the semiconductors broke their downtrend line. They had tested these lows, made the higher lows. Now they're making higher highs, and they are stair-stepping higher highs and higher lows in here. So that's encouraging on this time frame. However, of course, you back it up to the bigger picture, and you say, it made it up to where it was supposed to today. The next level where we would expect to encounter some supply in this market is basically this prior support level and into this gap area. So again, $26.60 to $27 a share, $26.90 is where we would expect to encounter some resistance in the semiconductors because it was a prior level of support, and right here this is where we had broken on a gap lower. That's also right now this area where that 50-day green 50-day moving average is. So it seems as though the market is telling us we have probably limited upside here, and that but right now in the intermediate term, the path of least resistance is higher, and I consider the intermediate term 2 to 6, 7 days, something like that. Anyways, it is higher. We are showing a constructive pattern here on this 10-minute time frame of the SMH. These higher highs and higher lows. So in the prior resistance, basically, it's not always exactly perfect, but the prior resistance, we dipped below that and then rallied. This market was a little bit cleaner, I guess you could say, trading today because it gapped down, it rallied back above that daily VWAP and held above there, and it continued to show higher highs and higher lows above this daily VWAP all day long. So the semiconductors are a little bit healthier here over the intermediate term, but on the daily time frame, they're still looking pretty sick. These, of course, had bounced from the 200-day moving average. So, this is, markets don't, just as markets don't bottom all at once, it's a bottoming process. Well, tops are a process as well. If you look back to, this prior, where we broke down hard from, and then we rallied up beyond a declining 40-week or 200-day moving average. So, anyways, we're now maybe in this distributive period in here for the semiconductors that maybe we even rally up, create a lower high. These, this 40-week moving average begins to flatten out, and then sometime later this year we break the bigger support levels, and then we get the real the bearish move to settle in Otherwise, the weekly time frame, you have to be encouraged that it did hold the 200-day moving average for now, and we have to just treat it cautiously. We're in an environment where, we had what we had before basically the first week of this year was we had an uptrend on the weekly time frames and we had uptrends on the daily time frames. Now we've got downtrends on the daily time frames, but still uptrends on the weekly time frame. So it makes it a trickier environment. That's why there's a lot of frustration in this market, because things are not following through. It's not, your imagination. I get a lot of emails, people saying, does it seem like it's choppier here? Yeah, it is choppier here, and that means that, we're possibly undergoing distribution. And you look at the volume patterns and that sort of thing, and where has the bigger volume been coming in on these markets? The bigger volume has been coming in on the downside. Now, we had bigger volume stability here a week ago Friday, and now we're kind of adding to that a little bit. So these levels, these lines in the sand, basically for the NASDAQ at 44 are going to prove to be important pivotal points next week. We have a holiday shortened week with the market closed on Monday, and we have options expiration on Friday as well. So obviously it's always going to be interesting. Everyone always says next week's going to be pivotal. Every week is pivotal. I mean, if you've got your money in the game, it's important, it matters, and you have to take it seriously all the time, obviously. The the Russell 2000 kind of getting back up towards, 62.5 was a big level late last year, and December 31st lows, and then we had broken down through that. That's a bigger level in the Russell. We've also got that the 50-day moving average right around the 6170 level. Today we had heavier volume and intermediate term, looking at a 30-minute time frame. We're up to a declining 20-day moving average. Let's look at the daily. We're up to that 20-day moving average. That's the blue one, which is equal to here the green moving average. Okay, but we've got we've had a pretty impressive rally this week. Now we've got to say, is there are we going to encounter supply up here? Right now we're not showing any signs of this budding uptrend encountering resistance, but if it's going to, this is, we're getting close to that point. $61.80 to $62 a share is where we're likely to encounter the bigger source of supply in the Russell. But again, same thing. We're above a rising 5-day moving average, and when these markets gap lower, buyers come in and save it. The financials continue to flirt with this 200-day moving average. You look at some of the components like J.P. Morgan. I mean, J.P. Morgan just looks like death to me. Really looks like these lower highs. This thing could just break lower any moment below this bigger level of support. But if it obviously if it rallies up through that 40 level, then you gotta look at it differently. Goldman Sachs, same thing. Goldman broke the 160 level. And just looking like a really unconvincing stabilization here below the 20-day moving average. So you got to look at these financials and really you look at them and say they're still overall basically for the most part we've got that's not the financials, XLF. We're basically still take a couple horizontal lines like this. And like this, we're at the bottom end of the range that has plagued this market for the last 6 months. And now we're at the bottom end of that range. This is the 6-month range that we've been in. We're at the bottom end of it. It's trying to stabilize. If it fails this time, then we'd probably be looking at the next level down near $13.15, and then below that about $12.80. So financials. They were actually lower for the week, so that's not a good sign for the S&P 500. They closed out here and they were down on the week, so and barely able to really. They're stable. They're neutral here, pretty much for the week, but still a sore spot and potential reason to look at this market very negatively if they do break down next week. The IYR had shown some good downside trades earlier this week. I've been saying the last 2 days that basically it looks like the easy money for now has been made on the short side. We're back above the 5-day moving average. The 5-day moving average is advancing. We've taken out a little bit of resistance at $43 a share, and we've got these higher lows in here as well. So, for now, the Russell 2000 next bigger level of potential resistance at about $43.80. Let's see how the market. I'm sorry, that's not even true. We have to look at this level here of $43 and basically 40 cents. That was important late in January, breaking below the late January or breaking back above that. Then we put this 43.80 level back into play. But IOIR, there's no reason in my mind to be long for more than just a very short-term trade. If you're looking at these 10-minute time frames, my opinion is you're better off just avoiding it because we have the mixed signals from the daily time frame where we have a declining 10, 20, and 50-day moving average, and the market's stuck below all those moving averages. And let's take a look at Twitter here, see what you guys want to take a look at. Let me just mention a couple stocks first, actually. Let's see, we had covered this one for subscribers today. We got short over here. We missed the BGC. This was one that subscribed. I was looking at for subscribers and mentioned here a couple times as well that it looked vulnerable as it was below all these moving averages. But they reported earnings. I don't like to be in when they report earnings, and the stock got buried today, so I missed that one. But anyways, I've been talking about Dendreon, and Dendreon is one of these, I've been saying also pretty consistently that I really don't feel comfortable with the common stock because it's very choppy the way it trades. But to hold call options is a much less stressful way. I've taken out more money in this stock since I purchased and tweeted that I was buying call options on this day right here. And I bought them at 72 cents, I believe. They're $1.56. I know that because I just sold some near the close and now have a third position left. So I can't lose in this position now, and that's obviously the position you want to be in when you have options. You take out more than you've put in, and you got 4 days to ride it. It's looking at it's at all-time highs. There's still about 9 million shares short in here, so this is one that could continue to go. But somebody was asking on Twitter late in the day, what gives you the bad feeling about Dendreon? It's not that I have a bad feeling about the stock. It's just that it's a biotech stock. So I don't trust them. I don't do any research as to when the news is coming. I probably should, but to me, it's a stock in an uptrend. It's breaking out. I give it the benefit of the doubt, but manage risk. And the best way for me to manage risk that's comfortable for the way I do it is through call options, because when the stock drops a buck and I'm down 30% in the options, I'm not feeling so bad about it as if I was still holding the stock and being down on it. I give it a little bit of room more because I know it's still got a constructive pattern, and then it worked out. So it's just personal preference. Acor was one I was mentioning last night for subscribers to look at as well. This stock got going nicely today once it took out this little resistance. So Acor, if you're in it, stop below this 30.75 area. Align Technology, we were looking for a pullback or a little bit of stabilization rather near that 5-day moving average. I think we're seeing that now, and the 5-day moving average is starting to flatten out. So Align Technology, ALGN, it had gapped up on earnings here, pulled back. The daily actually looks a little bit more neutral than anything. When you back it up to a weekly, it's still got some room to run, but I think next week that Align could be a good low-risk play with a stop below about $17.20. This one was a nice one today that we were talking about last night, which is the Acme Packet, APKT. Real nice breakout in there today, so if you got involved, I had suggested that you take at least part of it off in the midday video. Stop on the balance, probably about $14.30. Connexent was also a nice one that we were looking at getting above this level here. So if you're in Connexent, worst case stop at break even right now. The home builders, Dr. Horton, Ryland, XHB. I was looking at these stocks today. Ryland was nice yesterday. Ryland had a good momentum move, but That is yesterday over here. But right now, I look at it and I'm just, these home builders are just too slow for my interest level. Shuffle Master did get going a little bit today as well, above that $19 or $9.15 level. Shuffle Master looks decent. Looks like it could continue to rally, probably up towards $10 a share. We'll see how it handles that. If it can get above $10 a share, then you look at this weekly time frame, and it still looks like it has some room to run, maybe up to about 11.5 or so. Anyway, so those were the stocks I wanted to talk about. So subscriber, I don't have to do a second video for subscribers. And what I'm going to do right now is go ahead and take a look at the Twitter stream and see what stocks you guys want to take a look at.